Until now, every option we've discussed has involved one common idea. You borrow money and eventually you pay it back. Makes sense. That's how most people think about accessing equity. But what if I told you there was another option? One that doesn't work like a traditional loan at all? No, it's not a refinance. It's not a HELOC and it's not a reverse mortgage. It's called a home equity investment, sometimes referred to as a shared equity agreement. And for many homeowners, it's the option they've never heard of. Here's the simple version. Instead of borrowing money from a lender, an investment company provides cash today. And in exchange, they receive a portion of your home's future value according to that agreement. Now, when homeowners first hear this, the reactions are usually very different. Some people immediately love the concept, others immediately hate it. And honestly, both reactions are understandable because what makes this option attractive is also what makes it controversial. So let's start with the attraction. For some homeowners, the biggest challenge isn't equity. They have plenty of equity. The challenge is qualifying for traditional financing. Maybe their income doesn't fit neatly into a lender's box. Maybe they're self employed. Maybe they're between major life transitions. Maybe they simply don't want another monthly loan payment. That's where this option sometimes enters the conversation. It can provide access to cash without creating a traditional monthly payment obligation. For certain homeowners, that's incredibly appealing. But then every advantage has a cost or a trade off because while you may not be taking on traditional loan payments, you're sharing a portion of your home's future equity according to the terms of the agreement. And that's a trade off some homeowners are comfortable making, while others nothing to do with it. Neither reaction is automatically right. Neither reaction is automatically wrong. It comes back to the same question we've been asking throughout this entire video. What are you trying to accomplish? Because the goal isn't maximizing flexibility. The goal isn't minimizing payments. The goal isn't avoiding debt. The goal is finding the strategy that best aligns with your financial priorities. For some homeowners, a home equity investment becomes a creative solution. For others, it gets crossed off the list immediately. And both outcomes are perfectly okay. But what if none of these options feels right? What if the simplest answer also is the most obvious one? Let's talk about that next.